Welcome to TheoTrade. This is Don Kaufman, May 6th, 2022. 15 minutes to go to the cash close here on this Friday afternoon. Into the eye of the volatility storm is the theme of this weekend's update. First and foremost, some unprecedented volatility kind of transpiring throughout the course of this week. Yeah, we're going to discuss that in some detail, but most of the statements I'm actually going to make in this weekend update are very much forward looking. I mean, some of the aspects we got to talk about obviously is what to do to kind of gauge some of the risk ahead of us. I'm actually going to take you guys through kind of a quick exercise of expected move to make sure that you fully understand what's actually ahead of us and what kind of lies ahead in individual products and the S&P. And then, of course, what's kind of working, what's not, what's oversold, what's not. Let's actually start again with just a brief market update here. One of the first things that everybody's kind of talking about, and again, we got 15 minutes left. The S&Ps, they're just all over the place right now. But net on the week, and again, what everybody's talking about is just some of the unprecedented volatility. I mean, the overall movement on a day-to-day basis. But here's the crazy part, I think, of the entire trading week, all summed up, okay, by the weekly expected move. So we were anticipating this week, all right, roughly plus or minus $168. And we got every bit of that and then some. I mean, literally on Wednesday, we hit the upper edge of the expected move. By Thursday, we were actually right back down. But if you just closed your eyes and, you slept through the entire week and turn the screen on right now, we are massively unchanged on the entire week. What happened this week? Absolutely nothing. But at the exact same time, everything has transpired throughout the course of this week. So in terms of like updating you in price action, what's the point? One of the things I think that I would like to kind of elaborate on though here is today, again, on this Friday afternoon, we did touch down to like 40, 60-ish, and we are just a few handles off the lows that had actually happened again, the other day at 40.56. It, leaves me a little bit uneasy, but I think at some point, a lot of people are going to be screaming, it's a double bottom. Again, I'm not going to sit here over the next 20 minutes and try to handicap every move that this market is going to make, or I'll imply what the risk happens to be out there. But one of the things that you have to really start to rationalize in the midst of volatility, okay, first and foremost, major levels, they matter. Like, we know that if you look back, and again, I'm actually going to snap out to like a 30-day 1 hour chart. I find this one really interesting because when you look at this in the 1 hour time frame, what you actually see is this just really huge volatility box that's kind of progressing along here. Highs up right and around 4,300, right? Lows right here at 4,050. It's just a big vicious volatility box again that we've been in for quite some time, and just north of like this midpoint over here, that happens to be none other than 42.11. And it almost feels like, every time that we get a little overbought, a little oversold, we actually just migrate right back into what we term our 42.11, which we term a gravity point here. All right. So where do we go from there? So we're just pinging back and forth. And again, people are screaming already, of course, about a double bottom that might be in play. Again, one of the things that I'll stress in the midst of volatility, and when it comes down to it in volatility, listen, this is where I made my career. And I always tell this to people, but I was born into volatility. I grew up around traders, but my first year of trading was actually 98. 3 weeks out of college, so I ended up in Chicago in 1998. Obviously, I traded through the internet boom bust. I've been, through quite a bit. Obviously, thinkorswim, all the way from 2001 to 2008. Obviously, in the risk management side of things as well. I've seen a lot. But the one aspect is stop trying to handicap every single move. And if there's one thing for 15 years working behind the screens at thinkorswim and TD Ameritrade that you'll learn, is everybody sees the exact same movie at the same time. It's a rally, it's a sell-off, okay? And they get caught looking. I'm not going to for a second tell you that this is a double bottom, because I think that logic would be absolutely archaic. I mean, you have to recognize this marketplace is reacting to everything. I mean, the marketplace as a whole is just a giant powder keg of risk right now. I mean, don't listen and don't take my word for it. You look over at the volatility, we're sitting at almost a 30 volatility. Ironically, volatility down with the marketplace down right now. So it's a powder keg of risk. And every little aspect that gets thrown at it, okay, it could ignite. And if you don't believe that one, well, you only have to look at the Fed announcement. I thought that the Fed came out was incredibly hawkish. Like, I listened to the same thing that everybody else listened to about the Fed. And again, if you look at this on the 30-day 1 hour, and if you will, I'll just zoom into it for just a brief and fleeting moment. What I heard the Fed say was like, I'm going to put the brakes on this marketplace. We exploded higher, only to turn around and get slammed back down. And I'll tell you what, that's what I call the Fed bid and the smack back. I really wanted to bear up here at 4,300. Hey, listen, I never even got that opportunity. I was going to go out and maybe buy some put spreads and do a couple in-out spreads, do a little dance, make a little love. Never even got time to do it. I mean, we spent literally, if you look at this, there's 2 hours of up. That night was we already slipped overnight, and next thing, 3 hours of getting slammed right back down below that Fed announcement. Okay, don't forget it. That's what volatility can do. Stop trying to handicap every single move. It's one of the first takeaways you need to have in this weekend's update. I mean, that's what I'm talking about here when I talk about into the eye of the volatility storm. You think you know what's coming? You know nothing. And I don't say that to be at all like pessimistic, okay? But you got to check what you think in this marketplace. And it's going to be much more about risk management. And I am adamant about that. I know people, they hear that, like, I'm going to tune into somebody with Fibonacci's and Bollinger Bands. Okay. Listen, when markets become a free for all, you have to understand that that's exactly what they are. Right. So at any given point when we're volatile, you just got to sit back and actually kind of prepare yourself for more pain. And that could actually be on both sides of the equation. It doesn't necessarily pertain to being long or short. You got to look at both sides and check, okay, your ego at the door and say like, hey, this marketplace next week is going to move, for instance, up or down $150. Okay, prepare for impact. Could be on either side of that. You're going to see some explosive rallies. You're going to see some really violent sell-offs. The one thing is, and I'm going to talk about this a little bit, this marketplace it's an oversold territory. But this is also, although a low probability, this is the kind of marketplace that can crash and burn 300-400 S&P points inside of a day. Kind of felt that way yesterday. I mean, on Thursday, we escaped, what I call a almost sudden death over here, and held it together inside of the Nasdaq. Nevertheless, volatility, prepare for more pain. You have to be able to prepare for pain, whatever side of the marketplace you're on. Here's one of the big disconcerting things. If you're looking at this market right now, you got to look at bonds, and you obviously have to look at rates. And I've talked about this pretty much till I'm blue in the face. People, the bonds have absolutely crashed. And with bonds crashing, what do you have? Take a look at the TNX. The TNX, which is the 10 years, exploded. We're already trading 3.1%. Behold. Okay, you want to look at this like on a 5-year chart. After you're done on a 5-year chart, go ahead and hit the max chart. Why? You're actually seeing one of the fastest increases, okay, in the 10-year, in the history of the 10-year. Why does that matter? I don't know. What do you think the implications of a 10-year exploding to the upside like this are going to be? Forget where it is. It doesn't matter that it's at 3.1%. I just want to know, if you took interest rates, okay, and interest rates, a short time ago, we're sitting at 1.5%. And again, we're looking at a monthly chart, so let's be fair, okay? They're sitting literally right here at 1.8%, and you jammed them up to 3.1%. You got to ask yourself, what do you think is going to break? Okay, what is this going to break in the marketplace? And there's plentiful answers to that. Okay, I'll leave that to your own devices. So bonds got crushed, rates soared, markets broke. The only problem I have with this is I start looking at the interest rates and I start seeing them fly. And by the way, when it comes to the 10-year, you realize it's up, okay, on a year-to-date basis, okay, even though it's 3.1%, they're up almost 100%. The 10 years up almost 100%. You want to see something really scary? Go take a look at the FVX. The FVX is actually up about 123% year-to-date basis. So if you take a look at the, again, this is the 5-year. If you're looking at the 5-year, this thing was actually sitting at the beginning of the year just north of 1.2%. They're actually over 3%. Can't be warm and fuzzy about this. All right. And that's why I talk about into the eye of the volatility storm. Now, I actually want to cruise over to the spiders. And the argument that I want to make at the spiders is I want you to go to the exact same time frame in the chart that you just used in the interest rates. Right. So again, I'm actually going to show you this. I had up the TNX exploding to the upside, and I went over to max chart. Okay. And you're like, holy, like that's brutal. Right. And then I want you to cruise over to the spiders. And I want you to see exactly what I see. And that's this. Ruh-roh. Okay, this is not good, right? Because you're looking back here, the 250 level was the COVID. I mean, COVID got us all the way back down to the 220 something level in there. So for anybody that's actually talking about, the double bottom over here, I want you to do exactly what I just did. I want you to look at interest rates exploding, recognize the bond market has effectively crashed. It doesn't matter where the bond market goes from now. It does not matter. The damage has already been inflicted, okay, to the treasuries. And the treasury market, all right, let's be very frank. If you could talk about all bond markets, I mean, the S&P 500 is minuscule in comparison to the debt market. With that, you look at the S&Ps and it's intimidating as can be. I mean, you could see a market at 350, at 250, at 200 on the S&Ps, and that would actually be nothing. Because again, the magnitude of the move that you've actually seen, like look what's transpired inside of the bonds, okay? It's intimidating to say the least. All right, the other aspect in here, I'm not just gonna tell people, oh, it's about interest rates exploding. If you're not into the rates, you should look at the dollar. The dollar's actually broken out. This has been a safe haven. Now the dollar's tough to look at in a max chart because the world was a very different place, umpteen years ago, 20, even 30 years ago is a very different place. But the rate of change of the dollar to the upside here is intimidating simply in respect to the fact that, to me, what it means is duck and cover. Duck and cover. And the dollar breaking out to the upside, and it broke, okay, to the upside. The dollar breaking out was indicative of there's no safe place in the world, okay? There's no place like dollar. There's no place like dollar. It's extraordinary, and it is dangerous. All right, so back to the S&Ps and coming into the cash close here, literally just minutes away. And again, this was a rip your face off rally, turned right back around. Again, anybody's marketplace. So the brief market update here. Yeah, we talked a little bit about risk. We talked about bonds getting crushed, rates soared. Again, net, what are we going to do in the week? Absolutely nothing. Onward and upward. What I do want to talk about next is a little bit about what's oversold in this marketplace and what's not. And I'm not doing this just because I'm looking for opportunities. And I am going to be looking for some opportunities in here. But I want to make a couple of really, what I would term critical points from some experience in the midst of volatility. So let's go look at a couple of stocks again that are oversold. And by the way, I'm having some fun with this. If you haven't looked on the screen right now, I'm like Caterpillar, Walmart, XLF, XLP. You're not really sure looking at this what's oversold and what's not. But nevertheless, 45 seconds to play in the marketplace. SPOOs are going to end the week. Again, just unchanged over here. Nasdaq's definitely going to be down a little bit this week, but would you have thought that the S&Ps would be down 23, 24 with the volatility also down? We're going to come back again a little bit to volatility here momentarily. All right, so what's oversold and what's not? We start talking about the term oversold. One of the first things I actually want to bring to your attention would be something like Amazon. And again, all I want to do is look at Amazon is on a year-to-date basis. Amazon's now down about 32% on a year-to-date basis. Do me a favor, open up like a 3-year chart. Okay, it's a pretty devastating hit that Amazon's taking. And here's the closing bell. That is it, people. It is over for the week. So with that, if you take a look at Amazon on a 3-year, you can see how much damage has actually been inflicted. But again, the interesting, I think, irony of this is I'm actually now going to move to a 3-year weekly. Pretty much all of that damage has been inflicted in the last 3 weeks. Okay, would I actually constitute Amazon as oversold? Absolutely, unequivocally, yes. Okay, NVIDIA is right there with it, down about 38%. Okay, but then we're going to flip around a little bit, and I look at something like Apple. Okay, then I'm going to cruise over to Microsoft. And again, Apple, Microsoft's down about 18% on a year-to-date basis. You take a look at Apple, it's down about 13%. I don't like it. I don't have to like it. I don't want to like it. One of the things that you learn over a lot of years, especially in volatile markets, okay, volatility in percentages and correlation. What do I mean by that? Okay, when you look at a marketplace like this, and markets have, taken a pretty good lump on the head right now, and you're seeing the S&Ps come off, and they're down about 14%. But let's actually knock out to a full year chart, and obviously, that's 9 months. You even look at like 3 years, you're starting to see again some real damage being inflicted to the marketplace. What I'm bothered by, though, on this point, is that typically in the midst of volatility, yes, there are strong sectors and there are weaker sectors, correct? But when you look within the same sector, very often, especially when we start to talk about stuff like, monsters of tech, or you look at something like Google, take a look at Google on a year-to-date basis, down about 20%, okay? You look at, again, Microsoft, down about 18%, Apple, only down about 13%. On a percentage basis, all right, when you're in a particular sector, you usually see the marketplace hitting that market, okay, the same, meaning that if you're in the tech sector, everybody in tech is down 20%. What are the QQQs down right now? Okay, they're down about 23%. The bothersome point to be taken from this is that we're seeing percentage gains and losses all over the place, right? I mean, basically, it's all losses. You look at something like Tesla, it's off about 27%. You look again in NVIDIA, it's down 38%. You flip over to something like Facebook, it's 39%. People, it's a complete and utter free-for-all right now in terms of percentage losses. And one of the things you've learned over the years is that volatility doesn't usually subside, okay, until we come to some kind of happy medium, and that is we start smacking everything in accordance, right? So one of the things that's bothersome on this front, if you look actually in terms of the institutional, the money management world, look at 401ks and IRAs and so forth, you're going to see some of the top holdings unequivocally. They're going to be Microsoft, which is only down 18%. You're definitely going to see Apple, which of course is the biggest market cap, the biggest monkey on the block. Microsoft is right there with it. Amazon obviously is also, but Amazon's getting hit here for real at this point. What I'm bothered by, though, is when you start looking at stuff like Apple and you realize, wait a second, redemptions inside of funds, they haven't really transpired just yet. And stuff like Apple, listen, if there's going to be continued volatility, look for Apple to go down and go down dramatically. Okay, I would say that is probably one of the most pivotal underlyings right now inside of the S&P 500 that's actually holding the S&P 500 together. So again, with all due respect, you may love Apple and it's going to be the most widely held underlying, pretty much it's the biggest monkey in the S&P 500. At the exact same time, this is not a time to be loading up on Apple. Doesn't matter what you think. The risk reward in here is absolutely horrendous. Even if it bid back, okay, to the 175, you're like, come on, man, that's a huge rally. It's almost a 20-point rally in there. The downside, okay, is the abyss. And you start looking at this all the way out like on a 3-year, and you realize this underlying is unscathed. That's what I'm talking about with unscathed. You want to see what scathed means? Okay, you look at something like Netflix. You want to see what scathed means? You look at something like a 3-year on Amazon. There's damage being inflicted over here. Even stuff like Tesla at this point in the game has actually sustained some degree of damage. Apple, completely unscathed. You can even make the argument that Microsoft, okay, Microsoft is actually aligning. It looks like it's actually going to break through the 270 level. We're going to be off to the races to the downside. What I don't like today's marketplace, okay, yes, there's some stuff that's just dramatically oversold, but unfortunately, there's a number of key kind of constituents to the S&P 500, key constituents to the Nasdaq 100 that not only aren't oversold, they need to come into alignment with what is getting absolutely crushed out there. It would be extraordinary, unusual to say the least, to see a marketplace capitulate with everything not getting hit and hit hard across the board. It doesn't mean, by the way, just because I'm telling you, Amazon looks very oversold, that doesn't mean that Amazon is necessarily coming back up. What it actually means is Amazon could actually kind of stay down, okay? And then Apple's actually likely to catch it to the downside at some point. If the marketplace is going to continue with this bout of volatility. All right, you'll also look at stuff like if you're looking for short opportunities because you think the market's going to continue down, look no further. You look at stuff like Caterpillar, unscathed, just completely and totally unscathed. Year-to-date basis, it's actually up, okay? You have good reasons for that? Because I sure don't. Good reasons for Caterpillar being up. Oh, I don't even want to hear the fundamental side of it. It doesn't make a difference. You want to look at something, fundamentally, you would think something like what? Like Walmart. That's going to survive out there, except look at the volatility inside of the XLP. XLP could be another wonderful short opportunity in here. All right, XLU utilities. I know everybody's going to go duck and cover and buy utilities over here. Look, they actually ended up on the day. They're only paying a 2.6% dividend. Nobody wants a 2.6% dividend anymore when the 5-year is above 3%. I set you guys up for that one a little bit earlier. So with all due respect, what's oversold and what's not, you got to focus on that. Okay, onward and upward over here. Volatility, just briefly, I actually want to come over to the VIX. The VIX, okay, got to be careful where we are right now. Comes up to 34, we could actually just ignite and fly to 40. There is no in between. We actually see us aligning to 34 a number of times earlier in this year, okay? Here's the bottom line with volatility. We are at a very scary place inside of the S&Ps, a very scary place, okay? I'm not going to sit here and just, oh, we're definitely going to break lower, we're definitely going to break higher. It's a scary place in the S&Ps. We did close off the bottom of today, but minimally off the bottom of today. Again, just coming into Monday and Tuesday, it's going to be another wild week ahead of us. What I want you to recognize, what I want you to rationalize, volatility will not explode until it sees the marketplace do something scary. We go under 4,000, VIX will explode. We'll be at a 40 VIX in absolutely no time with the S&Ps under 4,000. Why do I say that? Okay, what do you care? Oh, the VIX is at 40. What does it matter to me? If you've sold some premium, it's going to be a little bit of fear and loathing, but at the exact same time, I'm telling you, it's opportunistic. If you're going to sell premium, you wait for the volatility explosion. All right, gauging risk, what's working? Okay, so yeah, we're going to talk a little bit about gauging some risk, and I'll actually use like Apple for just a brief example, brief and dirty example. For those of you, okay, if you're in TheoTrade, you're obviously going to be understanding expected moves. One of the first things I want you to do is I want you to look out, okay, and I'm going to highlight this right now, right around like 30-day volatility, okay? Look at about 30-day expiration and options, and cruise over here, and it says 13.45. Now, I am using Apple in this particular example. So we're actually going to write this up here, and I'm just going to round it, right? So just about a 30-day expiration. This says plus or minus, okay, 13, for instance, what? We'll call it 50, right? So here we are. We'll just round it to 1350. Now, I have a position, okay, of 300 shares of Apple. Bottom line, by the way, I have a position of actually, I'm short 300 shares of Apple. Okay, how much risk do I assume in the next 30 days? Ready for it? Okay, so I'm actually going to take you through this calculation, just a brief and dirty methodology over here. What you want to do is take the expected move, which obviously is about 1350, and you multiply it by what? By the number of shares you're long or short, which is 300. Whoops, swing and a miss. Let's do it again. 1350. Oh, I'll get this right eventually. 1350 times 300 equals 4,000. Okay, so in the next 28 days, all right, I'm actually going to write this up here for you, okay, just kind of round it. If you look at this, in the next 28 days, your P&L variance should be about plus 4,000 or minus 4,000, okay? And there's a 68% chance you're going to stay inside of that range. But if you're actually handicapping, okay, full-blown like risk and what's called probability of touching, there's a big difference between what we term probability of expiring and probability of touching. If you actually look at the distribution curve and you come right here and you say it's 1350, okay, that is actually what we term a probability of expiring. In this particular instance, if you're trying to handicap what your risk is going to be over the next 28 days, you would actually prefer to use a probability of touching. The probability of touching is roughly two times the probability of expiring. So to figure this out and do it properly, and again, as I said, I have 300 share position in here. It doesn't matter whether I'm long 300 shares or I'm short 300 shares. Okay, so let's actually take you through the exercise again, but now we're actually going to use probability of touching. So you take this $13.50, you multiply it by 2. Comes to obviously 27. Why? 27 is the probability of touching inside the next 28 days. Multiply that by the number of shares, which is roughly 300. P&L is basically 8,100. So one of the things to keep yourself and keep your kind of wits in the game is that you're going to have a P&L variance. P&L variance over the next 28 days, okay, of roughly $8,100. Take a look at it. That, people, is what you should focus on. It doesn't matter whether we go up or down. Question you have to ask yourself right now is, can you actually handle that? Gauging risk, okay, and what's working. That's expected moves in a nutshell. All right, premium selling and inflection point spreads. You want to know what's working and working the most effective right now? Take a look at none other than a couple of positions I have on. So forget about P&L for a second. What I'm actually doing, and I want to show you my S&P options on futures position. This is actually an inflection point. These are actually options that I have sold against this inflection point spread. Okay, that one little position, and this is a very minuscule position, is making $650 today, only tying up $7,677 in margin. I am actually collecting upwards of $145 a day, $145 a day in theta. That's the daily whittling down of an options value. But here's the actual best part of it. This delta right here, okay, is actually beta weighted as spider. I'm taking effectively zero directional risk, okay, to collect approximately $145 a day in theta. And you go, well, how are you up 650? And I'll tell you exactly how I'm up about 650 on the day. And the answer in very large part lies in the fact that, interestingly enough, volatility was actually down about a point today. Okay, so vol actually came out of the marketplace with the marketplace down. By the way, that does not bode well for the remainder, of course, of the well, into next week. And this is going to be a rough marketplace unequivocally. So what's working right now? Premium selling. I mean, because premium selling, the point I tried to make about this is non-directional. All I do is just gauge some of my risk. I'm taking 6 deltas of risk, which is the same as the equivalency of owning 6 shares of the spiders. But I'm getting paid $145 a day to do it. Now, I've got some other positions in here amounting to almost $30,000 in margin. This is just my premium selling position. Forget about everything else I'm doing on the screen. Who cares? It doesn't make a difference. In fact, I'll even isolate to this portfolio. It's called the TheoTrade portfolio. Portfolio is netting, and this is a small portfolio, about $337 a day in theta. Again, it's the daily whittling down of an options value. All right. Last but definitely not least, we come to expected move. Each and every week, we talk about not just handicapping risk in an individual underlying, but handicapping risk in the entire marketplace. And for that, we go over to the SPX. We look exactly 7 days out. Okay, this is not completely settled out, but here's really the crazy part. And I was kind of maybe alluding to this just a moment ago. I was like, wow, I mean, what? You have the S&Ps, they're down. The Nasdaq is down. The bonds are getting crushed over here. But the interesting irony, volatility is down too. What's so unique about this is if you look at last week's expected move, we were looking for plus or minus $168 last week. You realize the next week, which a lot can happen this next week, the expected move is only plus or minus about 137. Okay, volatility has actually come down. You go, well, why? Because I'm feeling the fear, and I'll tell you exactly why. We've already seen this movie before. Look where the market, okay, finished the week. Again, look where the marketplace finished the week. So if this is the upper edge of my expected move, the lower edge of my expected move, we finished massively unchanged on the entire week. The marketplace subsided a little bit. Volatility actually came off. Okay, we're all going to be in a world of volatility next week. Again, remember what you're dealing with inside of this marketplace. Volatility brings chaos. There's nothing wrong with a little chaos, especially when you're selling premium. Into the eye of the volatility storm we go. Thanks everybody for joining us here on this weekend update. Bye-bye.